Joining us today, Oakmark Funds Portfolio Manager Bill Nygren. Bill, thanks for kicking off the hour with us. Good to see you again.
Good morning, Carl. Thank you for having me.
I know we always talk about value and your very disciplined strategy, but can you sort of characterize the level of risk right now when it comes to watching earnings, margins, cash?
Well, I would say, the S&P is selling at something like 17 times estimated earnings. Given a 4% long bond, that doesn't seem like a crazy number to us. But what we do at Oakmark is always try to find things that are priced much more attractively than the market. And you can buy stocks today in the energy sector, in the financials, and in some of the consumer durables like autos at single-digit PEs. So we think it's much more important to focus on stock selection than to try and guess if the level of the market is exactly right or not.
Right. I am curious. I mean, let's dive right into a few of them. Capital One's a great example where I imagine you're going to talk about relative value, but how do you balance it with the concerns of, for example, the low end of the income spectrum and possible problems with delinquencies later in the year?
Sure. So Capital One is one of the country's leaders in credit card lending, also in auto lending. And unlike some of the biggest banks, they lend more to the near prime sector than prime sector. And I think for people that are kind of pulling out their recession playbook based on the last two recessions, there's a lot of concern about what will happen to charge-offs at Capital One. But we take great confidence in how strong the market is for unskilled labor right now. And people pay their credit card bills and their auto bills as long as they've got jobs. So we think that investors might be overestimating the weakness that you could see in not only Capital One, but the rest of the financial sector if we do go through a moderate recession.
But Bill, how does the cost of debt factor into that? Yes, they have jobs, they can pay off their auto loans, but they may not be able to keep up with interest rates going higher.
Well, I think that's probably more of a risk for the housing sector, where you're looking at very long-term interest rates. For a credit card loan, a change in near-term rates just doesn't change the payment all that much.
It doesn't?
No.
That's surprising. I mean, you always read about, 30% APR, and if interest rates are going to 5.5%, I mean, if Fed funds rates are going to 5.5% and rates are rising, I would think that the monthly payment gets a lot higher. No, it doesn't?
That 30 doesn't go up to 35 just because short-term rates went up.